Hello ladies and gentlemen, anything between. Today's video will be about disposal of assets with part exchange. I've already made another video about disposal of asset, however that one is with cash. So if you want to have a look at it, I'll put the link down below in the description. So before we actually get into a question and we deal with disposal, we should know these two definitions. First of all, what's a disposal? Disposal is the removal of a non-current asset from a business's accounting records. For example, when you sell a van, that van is no longer in your business, so through disposal, you remove it from your business's accounting records. So what's part exchange? It's a method of buying an asset in which including an asset of yours in the payment process. For example, you have a car, I'm interested in it, and you ask for 10,000. However, you say, if you give me your old car with it, I'll give it to you for 2,000. So that's part exchange. Okay, so now we've done that. This is the steps of disposing an asset with part exchange. I won't go through it just now, but we'll do the question first, and then when we start answering the question, we'll go through these steps one by one. Okay, so this is the question. This question, I've actually pulled it out from a real exam paper. So let's read it. Andy is the owner of a removal business called Murray Movers. I think that's how you say it. The business owns several motor vans that are used to move furniture. Extract from the balance sheet of Murray, I'm not even going to say the name, at 31st December 2012. Then it said motor vans, so these are the cost, depreciation, and net book value. Then underneath it says, during the year ended 31st December 2013, Andy purchased 3 motor vans in a part exchange arrangement agreed with Robinson Motors. The details are as follows. It says Andy purchased 3 new motor vans, which costed 45,000. He part exchanged 3 old motor vans that originally costed 27,000 and had a net book value of 12,000. Then he says he paid the balance owing for the new motor van with a check for 35,000. It is Andy's policy to provide a full year's depreciation in the year of acquisition and none in the year of disposal. Depreciation is provided at a rate of 33.1/2% per annum using the reducing balance method. So then it says prepare the motor van's costs, provision for depreciation, and disposal of motor vans account. Okay, so now we've read all of that. We go back to our steps first of all. Let's see what our first step says. It says open up a non-current asset account and enter the opening balance on the debit side, and open the provision for depreciation account and enter the opening balance on the credit side. The debit side is basically the left side and the credit side is the right side. If we go back to our question, it tells us the opening balances right at the top. It says the extract from the balance sheet of Murray Movers at 31st December is these down below. So the opening balance for motor vans is 90,000. So what we do, we open up the non-current asset account, which is a motor vans account. We write motor vans on the top, and then we go onto the debit side and we write balance brought down of 90,000. That's the opening balance. So we also have to make a provision for depreciation account, which we have an opening balance of 30,000. So we write provision for depreciation account for motor vans, or motor vans provision for depreciation account. And then on the credit side, we write balance brought down, and then we put 30,000. Okay, we've completed step 1. So now we're on step 2. Remove the original cost of the non-current asset that has been disposed, credit the non-current asset account, and debit the disposal account. So we go back to our question, and the second line, it says he part exchanged 3 old motor vans that had originally costed 27,000 in total and had a net book value of 12,000. So the asset that he's getting rid of is the 3 old motor vans, which cost 27,000. So to get rid of this, we go into our non-current asset account, our motor vans account, and we credit to by 27,000. We also have to open up our disposal account because we haven't, and we debited by 27,000. Step 2 complete. Now on step 3. Remove all depreciation of the asset that has been disposed from the date it was purchased to the date it was sold. Debit provision for depreciation account and credit disposal account. So what we do, we go back to our question, and it actually doesn't tell us the provision for depreciation account. However, it gives us the net book value of 12,000. So we do 27,000 minus 12,000, we get the provision for depreciation amount, which is 15,000. So we go into our provision for depreciation account of motor vans, we debit it by 15,000, and we go into our disposal account and credit it by 15,000. Step 3 completed as well. So we go to step 4. It says account for the part exchange allowance received for the asset disposed. Debit non-current asset account and credit the disposed account. You might be wondering, how do we actually work out the part exchange allowance? It's very, very easy. First, we were told that the 3 new motor vans that we purchased was for 45,000. Then we were told that we gave them 3 old motor vans to reduce the actual total of the new 3 motor vans. So we gave them the 3 old motor vans, and then we also paid them 35,000, which it says at the end, it says the owing balance of the new motor van, we paid it with a check of 35,000. So if you do 45,000 minus 35,000, we get 10,000. So our part exchange allowance is actually 10,000. So they valued our 3 old motor vans at 10,000. In simpler words, we paid 35,000 and we also gave them 3 old motor vans to get the 3 new motor vans, which cost 45,000. So now that we know it's 10,000, we put 10,000 on the debit side of the motor vans account, and we put 10,000 on the disposal account. Step 4 complete as well. Now on step 5, it says account for the money that has been paid for the asset. We do this by crediting bank and debiting disposal. We go back to our question. It says that he paid the balance owing for the new motor van with a check of 35,000. So we paid 35,000. So what we do is we credit the bank account. We haven't made a bank account, but I'll make it anyway so you just know what our double entry is. Every transaction has a double entry. So if you do something to disposal, you have to do something to something else. But this question doesn't ask for the bank anyways, but I'll make it just so you understand what's going on. So we write 35,000 on the credit side of the bank and 35,000 on the debit side of motor vans. We finished step 5 and we can go on to step 6, but before we go into step 6, if we go back to our question, there's actually a final adjustment that we have to make, which doesn't relate to the disposal adjustment anyways, but we have to do it because in the question it asks us to make the provision for depreciation account as well, and this adjustment actually relates to the provision for depreciation account only. So before we do step 6, let's go back to our adjustment. It says it is Andy's policy to provide a full year's depreciation in the year of acquisition and none in the year of disposal. Depreciation is provided at a rate of 33.1/3%, I think that's what it says, per annum using the reducing balance. So how we deal with this adjustment is we first remind ourselves what the reducing balance is. It's cost minus provision for depreciation times percentage, because in this case we've been given percentage. If it was years, we divide it by years. Alright, so what is the cost? We don't know the cost, and that's the thing. We've made the 3 accounts, the motor vans account, the provision for depreciation and the disposal. We have to close off the motor vans account to find out the cost. So how we do this is we total up the debit side of the motor vans, which equals 135,000. So you write 135,000 on both sides. So whichever side has the most amount of money, we write that amount. And in this case, it was the debit side, it's 135,000. So you write both of them. And then to balance them, we need to write an amount on the credit side. So we need to write 108,000 on the credit side and 108,000 on the debit side under the total. And in case you're wondering how I got that 108,000, I just did 135,000 minus 27,000. And the reason why we used the 108,000 as the cost is because that's the new balance brought down. That's the new cost of our motor vans. So we always use new data. So 108,000 is our cost. And then we need the provision for depreciation. So for provision for depreciation, we can't just close it off right now because obviously we're going to be including more depreciation. However, if we just do some quick maths, our old balance brought down was 30,000. So, and then we removed 15,000 because that was our old motor vans depreciation. So we don't include it. So if we do 30,000 minus 15,000, we get 15,000. So we use 15,000 as our new provision for depreciation amount to work out our reducing balance depreciation. So now we have our amounts. We do 108,000 minus 15,000 times 1/3%. And that gives us a total amount of 31,000. So where do we put this 31,000? We put it on the credit side of provision for depreciation. So we write 31,000 and we label it as depreciation expense. And I said before that every transaction leads to a double entry. In this case, it was provision for depreciation. And we also have to include 31,000 on the debit side of depreciation expense. But we don't have to do that right now because the question is not asking us for that. Okay, so now we've finished the final step. Now you have to go to step 6. It says close of the accounts. Transfer the profit or loss on disposal into the income statement. If it's on the debit side, it represents a profit. And if it's on the credit side, it represents a loss. So let's close off the accounts first of all. So we close off the provision for depreciation account first. We get a total of 61,000 on both sides first of all. So you write 61,000. And then obviously the debit side, you need to include something to balance them off. So you write 46,000 because 61,000 minus 15,000 equals 46,000. And we label it as balance carry down on the debit side, and we label it as balance brought down on the credit side. And then this last bit is a bit complicated, but it's very easy. So how do we balance off the disposal account? So as always, we write the total. So which side has the highest total? So the debit side is 27,000 and the credit side is 15,000 plus 10,000, which equals 25,000. So the debit side is more, so we write 27,000 on each side. And then we write the difference, obviously, on the side that's less. So if we do 27,000 minus 15,000 minus 10,000, we get 2,000. So the difference is 2,000. And we put it on the credit side. But as I said in step 6, it says transfer the profit or loss on disposal into the income statement. So we label it as transfer to income statement. And then it says if it's on the debit side, it's a profit. And if it's on the credit side, it's a loss. In our case, it's on the credit side. So that means the business has made a loss on its old motor vans. So when you do transfer these £2,000 into your income statement, you put it into the expense section. We label it as transfer to income statement. So that's the end, and that's how you do disposal using part exchange. I've also done a video, as I said at the start of the video, using cash. So if you want to have a look at that, I'll put it in the description. And yes, make sure you like and subscribe. Thank you very much for watching.